is that what's moving sentiment for this market lately? Just when and if there's a China trade deal?
I think we've been pricing out tail risk on the bad news side. Tail risk as it relates to Brexit and certainly as it relates to China. So as long as it still looks like the two sides are on track to reach a deal, there's not going to be sort of an implosion here and tariffs that go back up or rise even further than they did last year. The market's going to be, I think, relatively happy with that. The specifics of the deal seem a lot less important.
Do you agree with that, Kirk? It doesn't matter what's in the deal and seemingly doesn't matter whether it's struck in March or April?
Well, I think there will be a deal. There's an awful lot of pressure on both sides to do that. Obviously, the details matter, but I think a lot of this has to do with protecting technology. So I think to the extent there's a lot of protection, that's probably the thing that is most important.
So, Nick, where are you, Brian, where are you guys positioned at Nuveen for the rest of the year? Do you think that this stock market rally we've seen so far can last?
I think the discussion of GE and industrials is a pretty good stand-in for some of our concerns, which is that we got up to a really fast start. We priced out a lot of the bad news, but the big question is, with negative earnings momentum and concerns that 2020, yes, we could see earnings growth in 2020, 2021, we could avoid a recession, but we're still talking about mid-single-digit earnings growth versus last year when we had 20 or 25%. Those days are not going to come back, we don't think. Economic growth is going to be slower this year, is going to be slower next year. So the upside that the markets seem to be latching onto at the moment, or have latched onto in the first quarter, we're not sure it's going to continue. That momentum may slowly dissipate.
Hey, Kirk, I'm struck by this convergence of the VIX at multi-month lows, 13 and change today, even as the total of global bonds with a negative yield hits $9 trillion. How can those things coexist?
Well, I think this is a replay of 2018, or 2000, yes. And in other words, I think what's going to happen is you've seen a great start to the year, and then I think you're going to get some more volatility. So to your point, I expect the VIX will pick up. Bond yields seem to be stuck in this range, and you're right, German bund yields are almost negative. So I think the dollar is going to be stable, and I think this is a replay of last year.
So in other words, global liquidity has nowhere to go but U.S. equities? Is that the story?
I think U.S. equities are the place to be, and I think this is going to continue for a while until you've got a resolution on Brexit and a resolution on the trade war. So I think it's good to stay close to home. Obviously, things like emerging markets longer term are great value, but right now I think you have to be in the U.S.
So, Brian, you're not as optimistic on the U.S. stock market, but within the overall market, are there places you want to be?
We agree with Kirk that we do like emerging markets this year. The one area where I'd say it's a little bit different than last year is the bond market and the stock market don't agree on the outlook right now. In the beginning of last year, the bond market and the stock market were both pretty optimistic. We had rising interest rates, we had a rising stock market. Now is really more of like a choose-your-own-adventure story. If you want to believe the bond market, you're looking at weak Chinese data overnight. You're looking at the potential for further delays in the trade deal. If you want to believe the stock market...
But one of the hallmarks of the last 10 years in the bull market has been low bond yields.
Oh, sure. So when you have central banks sort of globally all kind of
that's the story
tapping
again, right?
Yeah, right. They're not going to be tightening nearly as much as we thought even 3 months ago. That has been tremendously helpful, and global disinflation is allowing that to happen. But it's not necessarily great news for stocks if the economy is slowing down just enough so that central banks don't have to tighten anymore.
Kirk, do you have a central bank forecast as part of your overall view of liking U.S. stocks this year? The Fed pauses, the Fed eases, is that part of it?
Well, I think the central banks are going to continue to be accommodative. Just a year ago, we were talking about maybe 2 or 3 more rate hikes, and now the talk is we're probably on hold. So central banks around the world are very accommodative, especially in Europe, and I think that will continue. And if you look at the U.S., I think a lot of expectation that the unwind of the balance sheet will slow down. So I think central banks are definitely driving the markets.
Finally, on whether or not Q1 is sort of this giant pothole, Eurozone data this week suggested maybe the worst was ending, and China data overnight, you could build the case that it actually got worse in February. So short term, what do you think the answer is?
You have to look at it, with a magnifying glass at some of these graphs to find the evidence of a turnaround, especially in China. We're optimistic that second quarter is going to be better in the U.S. The pothole is really in the first quarter.
Because of things like the shutdown and so on.
Correct. And we're also getting the data on a delay because of the shutdown. So the shutdown affected the economy and is also affecting our ability to gauge the strength of the economy, both at the same time. In China, we think it's going to be a little bit more of a slow comeback.
The jobless claims are trending a little bit higher. People are noticing that, that the trend is up, still historically low, but is that an alarming sign for the outlook for growth?
Yeah, that would tend to lead you to conclude that maybe last week's payroll report wasn't all just tight labor market, no availability of workers, that there actually maybe is a bit of a slowdown. And we're seeing that in small business data too. There are fewer small businesses who are planning to hire and who are planning to raise wages.